Okay, so what on earth does a tiny silicon chip in your phone have to do with your retirement plan? I know, it sounds like a totally random question, right? But the connection between the massive tech boom and your actual financial future, well, it's way more direct than you might think. And today, we're going to trace that exact link.
All right, first things first, we have to talk about the semiconductor industry. And when I say talk about it, I mean we really need to get our heads around the sheer scale of it all. It's just about impossible to overstate how important this stuff is to our modern world.
I mean, just think about your day for a second. The phone in your pocket, the laptop you work on, all that cloud storage, even the car you drive. Every single one of them runs on these incredibly tiny, complex little engines. They are, quite literally, the foundation of our entire digital world.
Okay, so look at this number. Just let it sink in for a moment. $1 trillion. That's a 1 with 12 zeros. This isn't just some random, abstract figure we pulled out of a hat. This is a forecast.
Yep, that's what experts project the global semiconductor market will be worth by 2030. Think about that. It's nearly double what it is today, which is already around $600 billion. And what's driving this insane growth? Well, it's two massive forces you're hearing about constantly. The explosion of artificial intelligence and, the rapid automation of pretty much everything.
So, $1 trillion can feel kind of abstract, right? Let's bring this whole concept right down to earth and talk about something most of us use every single day, our cars.
Because let's face it, cars aren't just mechanical beasts anymore. Not by a long shot. They're quickly turning into these super sophisticated computers on wheels. And that whole transformation, it's being fueled entirely by semiconductors.
A report from PwC really nailed it. They said we're moving past the idea of a car as just transportation. It's becoming a high-performance computer on wheels. And we're not just talking about a better stereo system here. No way. This is a complete reimagining of what a car even is.
And you can see the financial impact of this shift right away. Just look at the jump when you go from a regular gas-powered car to an EV. The cost of the chips inside goes way up. But honestly, that's just the beginning. Because the real leap, the game changer, is intelligence. As we climb that ladder of autonomous driving, from a little bit of help to a fully self-driving car, the value of the semiconductors packed inside just skyrockets. It can jump by a factor of 10, from under $500 to over $5,000. That is the engine powering all this growth. So okay, it's pretty clear this explosive growth in tech is a massive investment opportunity, right? But, and this is a big but, with that opportunity comes volatility. We all know that. And that up and down nature creates a very specific and honestly an often overlooked risk for regular investors like us. Look, over the long haul, investing in high-growth areas like tech is an incredibly powerful way to build wealth. The market tends to go up over time, right? It smooths out all those bumps along the way. If you're in your 20s or 30s, time is absolutely your best friend. And here's the question that connects that whole tech boom right back to your personal finances. What happens if one of those big market drops hits right when you need to start using that money? All of a sudden, time isn't on your side anymore. In fact, timing becomes your worst enemy.
And this right here brings us to a super critical concept, especially for anyone getting close to retirement. It's a risk that is all about timing, and it has a name: sequence of returns risk. So what the heck is that? Well, to put it simply, it's the danger that a big market downturn happens right at the beginning of your retirement. It forces you to sell your investments when they're down, just to have money to live on. And getting those bad returns at the start of when you're taking money out, oh man, it can do way more damage to your nest egg than if it happened later on. Think about your financial life like a two-act play. For decades, you're in Act 1, the accumulation stage. The goal is simple: growth. You can handle the market's ups and downs. But then you retire, and you enter Act 2, the distribution stage, and your goal does a complete 180. Now it's all about preservation. Suddenly that same volatility from those exciting tech stocks, it's not an opportunity anymore. It's a direct threat to the very money you've spent a lifetime building.
Okay, so if this risk is such a big deal, what do you do about it? Well, the answer definitely isn't trying to time the market. Trying to predict the exact peaks and valleys, that's a fool's errand, a losing game.
No. The smart strategy is all about managing your risk ahead of time. It's about adjusting how your money is allocated over the years to make sure it matches where you are in life.
And here's what that looks like in the real world. When you're younger, yeah, your portfolio is probably going to be heavy on growth assets like stocks, including those really exciting but volatile semiconductor companies we were just talking about. But as retirement gets closer on the horizon, you start to gradually, strategically shift some of that money into more stable things like bonds. You're basically trading some of that potential for huge gains in order to protect yourself from huge losses, right at the moment when that protection matters the most.
And so here we are, full circle. These huge technological shifts like the semiconductor boom are constantly reshaping our world. They create these incredible opportunities for growth. But that growth always comes with turbulence. So at the end of the day, the ultimate question isn't just about whether you're investing in the future. It's about whether your financial plan is built to withstand it. Is your plan ready for the very same volatility that's fueling that future?